Thanks for clicking! The Canadian government should allow extended amortizations up to 40 years for those renewing their mortgages. This according to a recent article coming from Rob McClister in the Financial Post.
Oh, you.
Yeah, we'll see that later. And the article comes in the aftermath of the release of CMHC's Residential Mortgage Industry Report, where the government mortgage insurer actually considered whether or not 40-year mortgages would reduce risk in the system. And of course, this idea isn't new. The real estate industry, mortgage brokers included, have been pushing this idea for a long time, seemingly forgetting, or more likely didn't know in the first place, that Canada did in fact at one point in time have 40-year mortgages. But in the aftermath of the financial crisis, tightened those standards in part to avoid a US-style housing meltdown. But, says the Financial Post, this is different. This time, increasing the amount of time borrowers have to pay off their mortgage would actually reduce risk.
We're all fine, everyone's fine.
So what I want to do today is briefly go over the CMHC report to which the Financial Post is referring, take a look at the Financial Post article arguing for 40-year amortizations, and then discuss some implications. Whether or not the government will loosen policy in the lead up to 25 and 26 remains to be seen, but we'll obviously continue to track that policy on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into these reports. On to the CMHC report, which asks if increasing the maximum amortization from 30 to 40 years would help to mitigate risk in Canada's mortgage market, especially given that the amount of risk in the market has doubled. The analysis found that increasing the max amortization from 30 to 40 years would only lead to a 5% reduction in monthly mortgage payments.
I'll take that deal!
CMHC's hypothetical analysis found that it's more likely that unemployment and higher interest rates would be the main driver of making mortgage payments unaffordable, and that longer amortizations only marginally reduce that risk. So, according to CMHC, the risk in the mortgage market has increased, but the answer is not to increase amortizations. The answer is not 40-year mortgages. And it's pretty easy to see why CMHC is recommending against 40-year mortgages. A recent study published about 3 weeks ago pointed to the obvious, that 40-year mortgages leave borrowers at risk come retirement, as more of their money goes to paying interest on their mortgage. Over 25 years, a $350,000 mortgage will see $141K of interest paid, but that same mortgage over 40 years will see $240,000 in interest paid. And that extra $100K is a lot less money that's going toward retirement, going towards savings, etc. Which is also basically what former Finance Minister Jim Flaherty said back when Ottawa decreased amortizations from 35 to 30, noting that the move would reduce interest payments being paid by Canadians. And Canada's banking regulator, OSFI, also chimed in as of recent as well, noting that it's not just borrowers that could suffer from longer amortizations, but the banks as well, as longer amortizations could lead to a greater persistence of outstanding balances and a greater risk of loss to lenders. Now, OSFI was discussing extended amortizations for those with variable rate mortgages but fixed payments, which we'll get to later, but the point still stands. On a $350K mortgage with a 5-year term and a 25-year amortization at 2.89, after 5 years, borrowers had paid back about $52,000 in principal. But bumped that amortization up to 40, and borrowers had only paid back about $25K. So, a longer amortization means that the banks are holding much more of the principal balance on their books, and if real estate values ever fall,
No way, never happened.
those longer amortizations increase the risk that the banks could be underwater with their mortgages, meaning more could be owed on those homes than they're actually worth.
That'll never happen.
So, according to the mortgage math, according to Canada's risk management since the global financial crisis, and according to Canada's banking regulator, extended amortizations are risky. But, says the Financial Post, while demonstrating the industry standard for rhetorical prowess, risk is also increased when borrowers don't make their mortgage payments at all. And that's definitely a good point. Why stop at 40? Go to 300.
Okay.
But, says McClister, there is a simple solution. Let borrowers extend their amortizations after extreme rate hiking cycles. And to demonstrate this idea, McClister points to a hypothetical couple that owes $300,000 after paying down their mortgage for 5 years at 2.89. Renewing with 20 years left, their mortgage payments will be around $2,000 per month. However, if the government were to allow them to renew into a 40-year amortization, that payment plummets to $1,464, which sounds great.
Doubt it.
Well, McClister conveniently omits what the couple had been paying in the run-up to that mortgage renewal, what the couple was paying for that last 5 years. And if we take the arduous step of opening up the government's mortgage calculator, we can see that that couple was paying about $1,636 on a mortgage that was $350K prior. Further, if we continue to play with the calculator, we find that that couple doesn't even need to have a 40-year amortization to maintain the same payment. They could extend up to 30 years, which is allowed by current regulations, and the payment would still be lower than they were paying for the past 5 years. So, the Post and McClister are making the argument that the government should allow the banks to take on, as we saw, riskier mortgages in order to not just maintain the same payment for current borrowers, but to lower them as well. Yeah, I'm sure that would be incredibly popular. Also, just as a brief side note, it is curious that McClister would choose to use a fixed rate example when even the Bank of Canada has said that the risk lies with those with variable rate mortgages but static payments, which could see their payments rise by 62%. Versus 25% for that of fixed. Curious even more, as back during the pandemic when HSBC was offering the 0.99% variable rate mortgage, McClister was quoted as saying that borrowers owe it to themselves to take a closer look at that mortgage, especially with rates to stay low until 2023.
Why would they lie? What would they have to gain?
So, it would seem to me at least that it would be those that took that sage advice, written right around the time the money supply had reached its highest peak in 25 years, that would benefit most from a government bailout. A minorly risky move that would bring risk management back to pre-GFC levels. Now, McClister does make the case that these non-existent mortgage holders have had it rough. The spouse has had his hours cut, and they have a lot of debt. But that's an appeal to emotion, which should immediately raise red flags, and doesn't really help for our purposes. And as for the banks taking on the additional risks that we discussed earlier, McClister says that the risk to the banks is minor, and leaves it at that.
Well, I'm satisfied.
Further, says McClister, it's not as though this would reignite the housing market, as he is arguing that these extended amortizations would only be for those renewing their mortgages. So, just to summarize, the argument being made is that the government should allow the banks to take on more risk to bail out those homeowners who had the good fortune of taking on a mortgage at sub 2% for the past 5 years.
Are you stupid or something?
But for non-home owners, current home buyers, those who were shut out of the market in 2020, 2021, and 2022, at least the early part, they get a different set of rules.
You're gonna be an awful popular fella.
Now, all of this isn't to say that these upcoming mortgage renewals are not going to be a problem and that families are going to struggle. Indeed, that probably is the case. But if we do go down that route, if we are going to bail out all of those home buyers from 2020, 2021, and 2022, let's be clear about that which is being argued. A return to pre-global financial crisis risk tolerance, all the while allowing different rules for different Canadians.
Because the rules are different for different people.
So, in summary, the Financial Post is arguing that the banks should be allowed to add more risk onto their books in order to provide a bailout for those who bought in 2020, 2021, and 2022. And for only those who bought in those years, as this bailout, as this longer amortization, would not be available to all Canadians. With that said, whether or not the government is going to ride to the rescue for those renewing their mortgages in 25 and 26, and whether or not they'll even need to, remains to be seen, but we'll obviously continue to track Canada's mortgage market on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.